Hi folks, this is the second part of the lecture. Today this is going to be about the stock valuation. So one part of evaluating stocks is the capital asset pricing model. That's going to help us determine risk of a stock. So the return of a stock is a way to express the financial performance of an investment, and it is essentially a percentage of what's been invested and what you get back. The risk, there are two parts to the risk of a stock. There's a standalone risk, which is the risk an investor faces if she has only one asset. And then there's the market risk, which is when it's part of a portfolio. It's related to the probability of earning a lower negative return. And the greater chance of lower than expected or negative returns, the riskier the investment. So the capital asset pricing model will help us determine relevant risk based on the contribution of a well-diversified portfolio's risk. So there is a risk-return trade-off. So for investing in general, we have return on stocks are uncertain. Risk is when your actual return is less than the expected return. And we always want to assume that investors are risk averse, so they want to avoid risk. The way that we can determine investment returns is by using the actual returns, which is calculated from historical data. And we can also find it from the expected or the average returns, which is the weighted average of expected returns on individual assets in the portfolio. So we're going to determine required rates of return based on risk and how to calculate that. So for an example one, we have an investment that has returns over the past 6 years, and we can see each time period from 1 through 6, and we can see what the actual returns were for each of those time periods. To the right, we have a graph that tells us how often we got returns of 10%, 15%, and 20%. And it looks like we had more 15% returns. We have 3 instances of that happening, whereas we have 1 10% and 2 20% returns. So by using that information, we can calculate some stats on that. So we can calculate our expected return, which is the average or the mean. So we take every value or every return from each year and divide it by the number of years. And here we get 15.8%. So that's the expected return. The risk is calculated using standard deviation. So you'll see this symbol, sigma, Greek for sigma. Okay, and that is calculating the standard deviation of that stock. I'm not going to ask you to calculate this, do not worry, but you need to understand how standard deviation determines the risk of a stock. So again, the expected return is the mean of the historical data, and then the risk is used by calculating the standard deviation. So we use that information to determine the probability distribution, and this may look familiar to you from stats, but here we have our normal distribution. Here is our mean. Okay, the mean that we calculated earlier was 15.8%. Okay, our standard deviation is 3.8. Okay, and this right here is our rate of return. So what's our possible rate of return? And we can have a rate of return of the average of 15.8%. We can go out 1 standard deviation, which means that our return would be 19.6%. We could go down a standard deviation, taking away the 3.8 standard deviation and having a return of 12%. So this is listing all the possible outcomes and the probability of each occurrence. 1 standard deviation going out is 68% of our value. So there's a 68% probability that we will have a return within one standard deviation. So there's a 68% probability that we'll have a return between 12% and 19.6%. Okay, the area under this curve is 100%. If we go out one standard deviation, this is 68% of our data. Okay, so there's a 68% probability that we will have a return between 12% and 19.6%. Just take a look at this and see standard deviation is 3.8. Okay, just keep that in mind. Now, if we look at these two stocks, we have stock Y and we have stock X. This represents the rate of return, and we can see our distribution. For stock Y, it's a little bit wider. Stock X is thinner. So which stock is riskier? Well, if we look, we can see the standard deviation for stock Y is going to be greater. It's bigger. It's longer, right? So we have a greater chance of getting a return that is on this end of the spectrum. However, with stock X, we have a smaller standard deviation, right? We have the same mean, but our standard deviation is smaller. So we could get a return anywhere from this 0% to whatever this percent may be. But for stock Y, we could lose 20%. So the stock with the greater standard deviation is going to be the riskier stock. There's a greater chance of getting a return that is well below the average. So again, the standard deviation measures the standalone risk of the investment, and the larger the standard deviation, the higher the probability that returns will be far below the expected return. Okay, so if we look at these examples here, we have a standard deviation of 0.05, a standard deviation of 1, and a standard deviation of 2. So given what we just learned, the riskier investment is going to be the green one, where we have a standard deviation of 2. The least risky is going to be the one in which we have a standard deviation of 0.5. So we want a smaller standard deviation, and we'll have a lesser probability of having returns below the expected return. Okay. If we have a portfolio, we can decrease our risk by having it be more diversified. So a portfolio is a collection of assets, and we have a risk-return trade-off for a portfolio. We would measure the portfolio expected return and then measure the portfolio standard deviation. So previously it was just based on one stock, but then if we're doing portfolios, it's based on the whole portfolio, the expected return of the portfolio, and then the standard deviation of the portfolio. So how do we calculate the expected return on a portfolio? Well, it depends on the expected return of each asset in the portfolio. So in this case, we have asset A and asset B. And it also depends on how much of that asset makes up the portfolio. So is it making up half of the portfolio? Does it make up 10% of the portfolio? So how much money is in that asset that makes up the portfolio? So in this case, the portfolio is made up of 30% of asset A and 70% of asset B. So say if there was $100 in the portfolio, $30 would be in asset A and $70 would be from asset B. So when we want to calculate the expected return of the portfolio, it's based on the weighted average of what is in the portfolio for each asset. Okay, so the expected return for our portfolio is going to be the weight of the asset times the expected return of that asset. So this is the 30% of asset A, which is a decimal, 0.3, times the expected return of asset A, which is 10%, plus the weighted average of or the weight of asset B, which is 70% of the portfolio, times the expected return of that asset, which is 16. And we get a 14.2% is our expected return. Okay, so it's the weighted average. It's based on how much of each asset is in the portfolio. So how does that work? So suppose you have $15,000 to invest and you have purchased securities in the following amounts. You have $10,000 of stock A, $5,000 of stock B. How do you find the weight of each stock in that portfolio? Well, you simply take the value of that stock and divide it by the total amount of the portfolio. So in this case, for stock A is $10,000 out of a total of $15,000. So it's 0.67, so that makes up 67% of the portfolio. For stock B, we have $5,000 in it out of the total of $15,000. So that is 33%. So stock B makes up 33% of the portfolio, and that's how we calculate the weights for the weights for the portfolio for each stock. So stock A is 67% of the portfolio. Stock B is 33% of the portfolio. So then that is going to help us calculate our expected return. So we already determined that the weight of asset A for our portfolio is 67%, and B is 33%. So we're going to assume the expected returns on each stock are 19.69 of stock A and 5.25 for stock B. So we can calculate the expected return of the portfolio by taking the weight that the asset holds in the portfolio and multiply it by the expected return of that asset. So asset A is 67% of the portfolio, so that's what we have here, 67%, 0.67. The expected return of that stock is 19.69%, so we multiply it by 19.69%. Stock B makes up 33% of our portfolio, so we have that here, 0.33. And the expected return of stock B is 5.25%, which is right here. So we multiply that. So then this is how we can calculate the expected return of the portfolio as a whole. It depends on the weight of each asset in each portfolio. Okay, so the expected return of the portfolio is the weight of each asset times the expected return of each asset in that portfolio. The standard deviation of the portfolio is not a weighted average of the standard deviation of each stock. It depends on the correlation of two stocks. The correlation of two stocks. So, again, if we have asset A, we have an expected return of 10% and a standard deviation of 20%. Asset B has an expected return of 16% with a standard deviation of 40%. Given portfolio of 30% of asset A and 70% of asset B, what is the standard deviation of the actual portfolio? We must take into account the correlation between each stock's return. The correlation of each stock's return. So here we have two stocks. This is the correlation and the risk for a two-stock portfolio. So in this case, we have firm Y and firm Z. The returns are the same. the exact same. Okay, so we have a correlation, which is represented by rho, of a positive 1. They have a positive correlation. If firm Y and firm Z look something like this with the returns, we have a correlation of 0. And then for this example, firm Z and then firm Y, they are complete opposites. So we have a correlation of -1. Okay. When one is going up, the other is going down. So if we look and compare these, we can look at the standard deviation of each example here based on the correlation. We have the same assets, right? Same part of the portfolio. The only thing that's different here is the correlation of the stocks. So if you look at the correlation of the stocks and you calculate the standard deviation, the portfolio that has a correlation of +1 has a standard deviation of 0.34. A correlation of 0 has a standard deviation of 0.286. And the portfolio with a correlation of -1 has a standard deviation of 0.220. So which portfolio has the least amount of risk? Well, it's the portfolio that has the correlation, that has a negative correlation. Okay, so the portfolio where stocks have a negative correlation, or the smaller correlation, will have a smaller standard deviation, which will lead to a smaller risk. So the standalone risk is equal to the market risk plus the firm-specific risk. Some of this risk you cannot control, but some you can. Market risk is based on the market, and that's systematic, and that cannot be eliminated by diversification. So this is represented by this big block here. This right here, we can't do anything about this risk, right? This is the standard deviation of the market, 20.4. And that's the risk that you take just by being in the market. What you can fix or eliminate a little bit is the firm-specific risk, and that's based on the individual what's in the portfolio, and that can be eliminated by diversification. So the more different types of portfolios and the more number of stocks in your portfolios, we can see that this risk, which is the firm-specific risk, as we increase in the number of stocks, this risk decreases over time. Okay, so the market risk stays the same, but as we increase in the number of stocks in the portfolio, our firm-specific risk decreases because we have more stocks. Okay, so the standard deviation for the market here is 20.4. If we have this many stocks in our portfolio, we would have a standard deviation of 25. If we go farther down, right, the more stocks we add, the closer we get to this market risk. So we can see here that this is being eliminated. It's getting smaller and smaller and smaller as we increase the number of stocks, and we're getting closer to our market risk. Another way to calculate market or systematic risk is by getting the beta of the portfolio. I'm not going to have you calculate beta. You'll be given beta for each stock or for each portfolio, but you need to understand how to use it and what it means. So it's used to indicate how risky a stock is when it's part of a well-diversified portfolio. If you hold a lot of investments, the stock's beta is a better measure than the stock's standard deviation. It also measures the stock's volatility relative to the market. So when we calculate beta, if it's equal to 1, it's just as risky as the average stock. If the beta is greater than 1, then it's riskier than average. If it's less than 1, then it's less risky than average. Most stocks have a range of betas between 0.5 and 1.5, and they're calculated by regressions on historical data. Regressions, just your standard equation formula. Y equals mx plus b. That's pretty much what it is. To calculate beta, you would use the correlation and standard deviation of the stocks, or you can run a regression in Excel to give you this equation. And your beta is actually the slope of your regression line. So if you remember back to algebra, y equals mx plus b. Remember, this here is your slope. This is also the beta in this case. Okay, so it's the slope of your regression line. So an example, using historical stock returns to calculate beta, we have this stock PQU, we have the market, and then we have each year. Okay, so for each year, this was the market return, this was the stock return, and this data is being used to create this function. Okay, if you were to plug this into Excel and run a regression, you would get this equation. Okay, so you would think of this as y equals 0.83 x plus 0.3. If we were looking at it as y equals mx plus b, this right here is the slope, so this is your beta. Okay, so the closer to 1, or the larger, it's greater than 1, is riskier, right? If it's equal to 1, it's about as risky as the market. Less than 1, or negative 1. There you go. Less than 1 is less risky. Greater than 1 is riskier. And it's equal to 1, then it's just as risky. So in this case, we have a beta of 0.83, which is less than 1, which means it's less risky than the average. Okay. We also have what's considered the required return, and this is the return that's required by an investor to hold the level of risk as measured by beta. So we use the capital asset pricing model for this, and it defines the relationship between risk and return. And we use the security market line to link the risk and the required returns. So what do we get? So our required return, so RA right here, RA, which is the required return of stock A, is going to be equal to whatever the risk-free return is. Okay. Plus the beta of that stock times the market risk premium. And the market risk premium is usually given to you, but it's the market risk minus the risk-free return. Okay, so the market risk premium, the beta, and your risk-free return will give you the required return for the stock in order for an investor to hold it. So how do we do that? So consider the betas for each of these assets. The risk-free rate is 2.13, so this would be a rate if an investment were risk-free. Okay, the market risk premium is 6%, so this means that because of how risky the market is, we're going to tack on that 6% to the expected return. And then we have to figure out what our required return is by using the beta for each security. So here we have security A, B, C, and D. These are the betas for each security. So remember, this determines how risky the security or the stock is. So here we have 2.13, and this is just the risk-free rate, as though, if there were absolutely no risk involved in this security, then this would be the rate that we would require. The market risk premium is 6, and this is based on what the market risk is minus the risk-free rate. Okay, and that's given to us, so it's 6%. And we're going to multiply that by our beta. So remember, the higher the beta, the more risky the stock is, or the security is. So we're going to see a higher rate of return, or required rate of return, right? Because we're multiplying. The only thing here that is different in each of these equations is our beta, right? Because they all have a 2.13 for the risk-free rate, and they all have a 6% for the market risk premium. So what really determines the required rate of return is the beta, right? How risky is this stock? The higher the beta, the higher the risk, the higher the required rate of return. For example, security B has a beta of 0.195. So the required rate of return for security B is 3%. Whereas the beta for security A is 2.685. So the required rate of return is 18.24%. Okay, notice how the difference is because it's being multiplied by this beta. The beta is much larger in security A. So the required rate of return is going to be greater because it's a riskier investment. So how do we calculate beta for a portfolio that has more than one stock? Well, we have to calculate the weighted beta. Okay, the weighted beta, or the weighted average, and that is determined by how much of each stock is in the portfolio, or how much the stock is, what percentage the stock is of that portfolio. So in this case, this portfolio has 50% of A and 50% of B. Okay, and stock A has a beta of 2.685. Stock B has a beta of 0.195. So to calculate the beta of the portfolio, we're going to multiply each stock's beta by the weight of the stock in that portfolio. So we have 50% of the beta of stock A plus 50% of the beta for stock B. So we're going to multiply the 50% of 2.685 plus 50% of 0.195, the beta for B. And in this case, we have a beta of 1.44. So now we can use this to determine the required rate of return for this portfolio. Okay, so we're going to use SML, which is how we calculate required rate of return. Okay, we already know that our risk-free rate is 2.13 and our market risk premium is 6%. So we plug in the beta of 1.44, which is the risk of this portfolio, to calculate our required return, which in this case is 10.77%. Now, if you notice, these two stocks were on the previous slide. Stock A had a required return of, 18%, right? Stock B had a required return of 3.3%. But if we put them together in a portfolio, half and half, our required return is now 10%, 10.77%. Okay, because it's based on the portfolio having 50% of A and 50% of B. So it brings down the risk a little bit from stock A, but it brings up a little bit because for stock B. Okay, so we're kind of averaging it out a little bit. So it's less riskier than just having A by itself. It's a little bit more risky than having B by itself. But that's how you calculate beta for a portfolio. Again, it's based on the weights of each stock in the portfolio and each individual stock's beta. So if we were to look at this, what would we do? Do we, based on the required versus the actual return, are we going to keep the investment, sell the investment, hold the investment? So we require 18.24%. The beta is 2.685, so it's super risky. The actual return is 17%, so what are we going to do? It's overpriced, we're going to sell it. Okay? We're not getting the required rate of return, and it is super risky. We don't want this. We're going to sell that security. For stock B, it's a 3.3% required with an actual of 3.3%, and our beta is 0.195, super low, not very risky. We're going to hold on to that sucker. Okay. For security C, we have a required rate of return of 15.10%. The actual return is 12.8%, which is lower than the required rate of return. Our beta is pretty high, 2.161. That's way risky, so we're going to sell that bad boy. We don't want that. That's too risky for us. Security D has a required rate of return of 16.73%. The actual return is greater than that, 20%. Okay? The beta is 2.4, which is really high, but we are above, our actual is above our required rate of return, so we're going to hold it. Okay, or we could buy it if we don't already have it. Okay, so this is just how to determine how risky a stock is, how risky a portfolio is, if we're going to hold the stock, if we're going to get rid of the stock, how to calculate the risk based on the portfolio, based on each stock, and the betas. Okay, so understanding what the beta means, understanding what how to calculate the required rate of return for each portfolio based on the weighted averages of the stocks in the portfolios. All of that is what this section is about. Okay, and you will have a couple of questions like this on the quiz. So you want to make sure that you know what beta means. You want to know how to calculate your required rate of return. And you want to know how to calculate the weights for each stock that is in your portfolio. Okay? There's no Excel for this, so there won't be an Excel demo for this. But I would go back and look at these problems on your own and try and come up with the required rate of return for each of those on your own using the betas and the weights. Okay? Thanks so much.